Oh my gosh, this cash flow's terrible.
Yeah, it's a little rough.
I thought it'd been higher.
Oh, wow. This is better than I expected. I wonder if they would have gotten that big of a spike had it not been for COVID.
So, what do we pay for Disney? Disney stock. Guys, Disney is an interesting company. During the shutdown, I think I read it was 40% of their revenue was in the parks, and Disney rebounded, went from like $80 some a share to 200, and now it's back down quite a bit. So we're gonna do a stock analysis on Disney. We're gonna look at the 8 pillars. We're gonna figure out what the right price for us to pay based on our assumptions. So Mo,
yes,
Disney's currently $100 a share.
Yes, it is.
All-time high, March 8th of 2021 at 203. Low, 52-week low, was just a few months ago at $84 a share.
Mm-hmm.
Okay,
Lower
so
than COVID.
What are the Disney Plus numbers? I mean, it skyrocketed during COVID, right? Why don't you pull that up while I start pulling up some general information on Disney? First off, guys, $182 billion market cap. Enterprise value of 267. Market cap is when you buy all the shares. Enterprise values, you buy all the debt and net cash along with it. 5-year return on invested capital is low, but remember, I think that has a lot to do with COVID and the shutdown and the losses that are incurred. Again, 5-year profit margin of 6.5%. I think if you look at history on Disney before shutdown, $75 billion in revenue, net income of 10, $59 billion in revenue, net income of 11. So I think the overall margin is around 15%, but it's been hurt a lot in the last few years. Mo, what'd you find out about Disney Plus?
161.8 million users.
Currently?
Yeah. That's as of the first quarter of 2023.
Okay.
That's a lot of users.
That's a lot of users. And I'm sure the growth is slowing.
Yeah, it's slowing for sure.
Yeah.
I think that was if I remember correctly, that was one of their big things that they said in their last quarterly report. They were kind of concerned that, not concerned, but it's going to start to slow because I wonder if they would have gotten that big of a spike had it not been for COVID.
Oh, no, they wouldn't have.
We would have had growth.
No, we wouldn't
have been this kind of growth.
I think they even said that.
Yeah.
But when COVID happened,
outrageous timing.
You're just like, oh, okay, we're just going to buy streaming. Everybody's streaming.
And it was like $5 a month at the time or something like that.
Mo, look at this revenue though. So it went from let's go back 46, 50, 55, 55, 56, 60, 75, dropped to 60 during COVID, 73, 84. It has massive record revenue. Yeah. Massively record revenue, okay? Now, let's go look at the profit, though. Very low.
Different story, yeah.
Yeah, but guys, the question you need to ask yourself, if you're the kind of investor who just goes off of the last year's PE earnings and multiplies by 15 PE, I don't think that's reasonable in this situation. Why? Because they have record revenue and they might just be working through some issues now in terms of profit and loss. I don't know. But the question to ask yourself, and the question any investor should ask here is, what's it going to take for them to get back to their days of 15% profit margin or 12% profit margin? Because if you're able to make 15% on $84 billion, how much is that? That's like, what, $13 billion in profit?
Yeah.
That'd be record profit for them. And they should have record profit on record revenue. So the number one question to ask here on Disney is, how long will it take them, and is it possible for them to get back to the regular profit margin? Now, my guess is, why wouldn't it be? They've added a ton of revenue, but it's in a high margin business like Disney Plus. Right?
Yeah.
And when you add that, and you have the parks back open, and they're increasing the cost of the parks, etc.
I'm actually quite surprised that their net income didn't rebound.
I'm very surprised by that.
I'm trying to think of where did it go.
But I will say this, I'm actually glad it's so bad. You know what I mean? I'm glad it's so bad that it makes me go, come on, this has got to rebound at some point.
Yeah.
Now, I don't know, let's go look at their numbers above. Where do you see big increase in costs? Okay, let's see. What about net interest? No, I mean, that is bigger, about $1 billion, but it's not making up for that. Let's see their gross profit. So look at this. One thing, Mo, look at this. Gross profit is actually, it should be way higher. Mm-hmm. If your gross profit margin is 33% overall, I mean, this should be a way higher number. Back here, it's 40% almost.
Yeah.
No, it's almost 50%. That's the interesting. It's like 45% here, and here it's 33%. So understanding their gross profit, that's where the gap is.
Total operating expenses at record highs.
But how much higher is it relative to
Let's see.
So let's look at operating expenses. Operating expenses, $21.6 billion on 84, which is 25%.
I guess it's
yeah, versus less than 20% before, about 20%. So you're right. Operating expenses it's the gross margin. Right, yeah. This gross margin is super low, which blows my mind because a lot of the revenue growth has come from Disney Plus. I mean, at 160 million users at what is it, $5-6 a month?
Well, let's see now. I know they just did price increases.
But even if it was $5 a month, 160 million users, $800 a month in extra revenue. That's $10 billion in extra revenue per year. So at an 80% margin, even at a 50% margin, that's a huge number, right?
Yeah.
That's a huge, oh look, $10 a month? That's with Hulu though.
I think it's, here it's at $7.99 a month with ads, so it's basic Disney Plus.
Let's look at their cash flow statement, Mo. Oh my gosh, this cash flow is terrible.
Yeah, it's a little rough.
Look at this cash flow, guys. $94 million in the last 12 months in cash flow.
Isn't that wild?
That's nuts. They were doing 6.6, 6.7, 7.3, 7.7. Okay, so if you believe in Disney long term and you believe that their gross margin is going to rebound, you have to value the company based on historical numbers. So guys, if you like the software, we're running a special, $7, 7 days, $1 per day. If I came to you and asked for $1 every day, you would never even ask for it back. This changes everything. It gives you everything you've seen so far, all of our tools, everything you're gonna see, including our stock analyzer tool coming up. So everythingmoney.com, $7 for 7 days. Now, when you're valuing Disney, I think it's incorrect to look at the last 2 or 3 years. You need to do your research on the gross margin. What's happening with that gross margin? Because that gross margin is everything. Their profit here, if you look at their income statement, gross margin, for those of you who don't know, is the actual profit you get for every extra dollar sold. Before, it was like 45%. Now it's down to 30%. That's a big drop in gross margin.
Significant, yeah.
Especially on a big increase in revenue.
Right.
You have an increase in revenue here of $10 billion. And when you added Disney Plus in there, which is which should be a high margin business.
Exactly.
Because every extra user is costing them pennies.
Right.
Right? All right, let's look at their 8 pillars real quick and laugh at this.
It's terrible.
Oh, yeah. So I have a custom 8 pillars in here. Remember, if you have the software here, guys, you can put your custom 8 pillars in. But this is our original 8 pillars. There is one check mark.
Yeah.
Revenue growth. So I don't think the question here is it an 8-pillar stock? Should you have to go back and look at this as a normalized, stable business. Mm-hmm. It's not normalized and stable right now. Revenue's up. Is this the new normal for Disney? If 3 or 4, 5% profit margin is the new normal for Disney, I have a hard time believing that. Yeah. When they have a whole history of doing double-digit profit margin to the bottom line, I have a hard time believing that the new normal is this bad.
Yeah, especially, I mean, it's not just Disney Plus. They have Hulu, they have ESPN. They have all of these high-margin businesses.
And with ESPN, it's sports.
And you can monetize that like crazy as well.
Yeah.
So
nobody watches anything live anymore except for sports. Right. So that you can get the really high ad dollars in sports with really high income generators there. Mm-hmm. All right? Yep. All right, so what do we pay for Disney?
But there's no analyst.
Oh, let's look at the analyst estimates.
There's like no analyst looking out beyond 2025.
Oh, wow. Well, look at these jumps, though.
Oh, wow. This is better than I expected from analysts.
Look at that. I mean, they have it over doubling in the next 4 or 5 years, which I'm actually surprised about, Mo. I thought it'd been higher.
Yeah.
Because look at $9.50 per share. What do they do? Let's do the per share quarterly, annual. Let's do per share quarterly here, Mo. Let's go back to 2019. Let's add it all up. So it's the third column, guys. You can do it in our software. Basic shares. So $1. So look, add this all up. 356. So hang on, I'll do it myself. 450, 510. So yeah, they were doing over $6 back in 2019.
Wow.
But at least it's getting back up there.
It's getting there, but I'm surprised how long this is taking to recover. To these.
Is their gross margin permanently impaired? Is their gross margin permanently going to be lower than 45%, which what it was in the years leading up to COVID?
Yeah.
I don't know. I don't think it will be, and these are analysts, and they want to go with the crowd. The revenue is expected to go up. Okay, so let's go do a wide. So this is why we like the stock analyzer tool. Now, guys, like I was saying before, the stock analyzer tool was used 1.3 million times last year by our users. It doesn't factor in the balance sheet. Mm-hmm. But it allows us to look at a company, make assumptions about the future, and every investment's the present value of all future cash flow. So Mo's going to do a 10-year analysis. I'm going to do 20. For those of you who are new to the channel, if this has seemed kind of fast, trust me when I say there are thousands of people here. We have 200,000 subscribers for a reason. You eventually click. You need to repeat this over and over. The more and more you do this, the better and better it'll get. And you'll understand this more and more. So we're going to do a quick pause. I'm going to put in my assumptions for 20 years, and I'm going to do a wide range. I'm going to assume the new normal. I'm going to assume they go back to normal, and all these things, and then something in between. Mo's going to do the same thing for 10 years, but we'll see the wide range of stock prices for Disney. So just hang on a second. All right, guys. So we just put it in there. Mo, what'd you do for revenue growth for the 10-year assumptions?
So I did 4, 7, and 10.
Okay, now for 20 years, I did 3, 5, and 7.
Okay.
Much longer outlook, so I think the growth is going to be a lot slower. Okay, Mo, profit margin.
I did 6, 9, and 12.
I did 4, saying this is the normal. I did 9, and I did 14, because they have hit 15% profit margin in the past. I'm okay with that.
Okay.
Free cash flow.
6, 8, and 10.
I did 4, 8, and 12. Okay. So we both decreased our free cash flow. And for those of you who watch, we looked at overall their free cash flow was lower than their profit margin, their net income. Mm-hmm. So adjusting for that and a little bit lower made sense. What'd you do for PE and price of free cash flow?
So I did 16, 18, and 20.
I don't blame you.
Yeah, I mean, that's the ultimate moat.
I did 15, 16 and a half, and 18. Now, guys, Mo just said that's the ultimate moat. PE and price of free cash flow basically goes on moat and return on invested capital. And their return on invested capital currently is not good because of the previous 5 years of results. But if I said to you, here's $280 billion, go start a new Disney, you ain't doing it. You're not going to take over Disney. That is a moat.
Yeah.
That's an incredible, incredible moat. So you should be willing to pay a premium for that company, right?
Yeah.
So maybe I should do a higher PE and price of free cash flow like Mo, but this is the art of investing. This is where you have to decide for yourself what is reasonable. This isn't something you just go, the right number for PE is this. There is no right number. There's what you're willing to accept. Warren Buffett probably will accept a much higher PE than we are. Why? Because he has way more capital and it's hard to deploy them in good investments. Right. Okay. Now, what'd you do for your desired annual return?
I did 10, 12, and 14.
So I did 9, 11 and a half, and 14. Okay. Could I have done, actually, you know what? I'm going to go 9, 11, and 13. And look, I just adjusted that right now because I thought to myself, like, I still think these are low. These are still low based on history. So I'm okay getting 11% return here. We hit the analyze button. Boop. Now, guys, there's a lot of red here. If this is the new normal for Disney, 30 is the price for me, even at a 9% return.
Yeah.
If we're wrong, it's about where it should be. On the high end, the middle side, 60 to 70. And I have it on my watch list at 80. Mo, what do you got?
Yeah, I have 46, 75 in that middle range, maybe 110. So we're kind of sitting there. It's 85 on the watch list for me.
So guys, this is the art of investing. Is this right or wrong? I don't know. But remember, every investment's the present value of all future cash flows. So go to everythingmoney.com, sign up for this so you can make your own assumptions, $7 for 7 days. Thank you for your time.